Herzlich willkommen zur Vorstellung des Gas Market Reports der Internationalen Energieagentur für das zweite Quartal 2026. Mein Name ist Charlie Grüneberg, ich leite die Kommunikation bei die Gas- und Wasserstoffwirtschaft. Die Auswirkungen der Krise im Persischen Golf sind inzwischen auch für private, gewerbliche und industrielle Verbraucherinnen und Verbraucher in Deutschland spürbar. Zwar schlagen sich Preisspitzen in der Gasversorgung nicht so unmittelbar nieder wie etwa bei Benzin und Öl, dennoch zeigt die aktuelle Lage sehr deutlich, wie die globalen Energiemärkte miteinander verbunden sind. Im heutigen Webinar wollen wir deshalb einordnen, welche kurz- und langfristigen Auswirkungen die Blockade der Straße von Hormuz auf die Energiemärkte hat, wie Erdgas und insbesondere LNG-Preise darauf reagieren und welche Mechanismen dazu beitragen können, die Märkte wieder ins Gleichgewicht zu bringen. Dazu begrüße ich wie üblich unsere beiden Experten der International Energy Agency, Gergely Mollner und Frederick Ritter. Das heutige Webinar findet als aufgezeichnete Zoom-Konferenz statt. Und wenn Sie, liebe Zuschauerinnen und Zuschauer, ganz drängende Fragen haben, dann schreiben Sie uns gerne eine E-Mail, dann versuchen wir die weiterzuleiten und Ihnen im Nachgang Antworten zu geben. Now I will switch to English. Welcome again, Gergely and Frederick. We are very pleased to have you with us today. The current crisis in the Persian Gulf has significantly disrupted global gas market fundamentals. The blockade of the Strait of Hormuz and the loss of around 20% of global LNG supply have driven prices to their highest levels since the energy crisis of 2022 and 2023. Today we want to take a closer look at how the market is reacting to these developments, how global gas prices and demand may evolve in the short and medium term, and what it will take for the market to rebalance under the current conditions. The latest IEA Gas Market Report provides valuable insights into these questions, and so, Gergely, the floor is yours.
Thank you so much for your kind words of introduction, and good afternoon for other colleagues who are joining us today. My name is Gergely Mollner, gas analyst at the International Energy Agency, where I coordinate our short and medium-term market analysis. And indeed, it is a great pleasure to join you today together with my colleague, Frederick Ritter. We just published at the end of April our latest quarterly gas report, which is available free of charge on our website. And I invite you to discover it. So today's presentation will be very much based on that report. It will have three parts. First, we will give a look back to the 2025-26 winter season, so the period between October to February. Then in the second part, we will look at the global market implications of the Middle East conflict. And in the third part of the presentation, Frederick will provide a focus on the impact on the Asian markets, which are the most directly exposed one to the current disruption of LNG flows via the Strait of Hormuz. So let's have a look specifically to the October-February period. The title here in French is Jusqu'ici tout va bien, which means so far so good. And when we are looking at the price dynamics during the October to February period, we indeed have seen quite some softening of the market fundamentals. So on this chart, we are showing the evolution of Asian and European gas prices since the beginning of 2025. It shows a year-on-year change. In dark blue, we have TTF prices, which is the European benchmark. And in light blue, we have JKM, which is a key marker for Northeast Asia. And we see that in the first quarter of 2025, prices have been on a somewhat bullish trend. And this has been reflecting the rather tight supply fundamentals, colder winter weather conditions, and relatively low renewable power output here in Europe. But we also see on this chart that the prices have been trending towards a softening throughout the year. And in the second half of 2025, both TTF and JKM have been trading already below their 2024 levels. And when we are looking at the last heating season, we see that both TTF and JKM averaged 25% below their previous winter season levels. And this has been supported by the rather strong increase in LNG supply, but also improving renewable power output here in Europe, which did provide downward pressure on natural gas prices. And on this slide, we are bringing a bit more detail on the supply picture. It shows the year-on-year change in global gas trade, including the key channels of supply, which here is European and China's piped gas imports, as well as global LNG supply. And what is quite visible here is that after the 2022-23 gas supply shock, the market moved towards a gradual rebalancing. And when we are looking at the 2025-26 heating season, we have seen a rather strong increase in LNG supply growth, which increased by 12% or 29 billion cubic meters. And almost half of that growth came from one LNG liquefaction plant, the Plaquemines LNG facility in Louisiana. And of course, this strong increase in LNG supply provided downward pressure on prices and eased up market conditions. Now, this somewhat lower price environment also stimulated stronger gas demand growth, including in the Asian markets. On this chart, we are showing our estimates for demand for a selection of European and Asian markets. In the case of Asia, we estimate that natural gas consumption increased by around 3% year-on-year over the October-February period. And this increase has been largely driven by China, Japan, as well as Thailand. When we look at more specifically to China, we have seen a rather strong increase of 5% in the city gas consumption, which was partly supported by stronger gas use in buildings amid colder weather conditions, but also the country's rapidly expanding LNG truck fleet. We have also seen more gas use in the power sector, as well as some recovery in natural gas use in the industrial sectors. So just to say that, of course, when we look at historical growth rates, 3% is relatively weak for Asia, but we need to put this into context. In 2025, Asia's natural gas demand growth slowed down to below 1%. So compared to that, we have seen some acceleration, and this has been largely supported by the lower gas price environment, which have been emerging on the back of stronger supply fundamentals. But I think it is also important to note that while natural gas demand growth has been somewhat moderate over the October-February period, the peakiness of natural gas consumption remained quite elevated because we once again faced a winter of storms. And on this chart, we are just showing how significant and how important is the flexibility of natural gas supply to ensure heat and electricity supply security across various markets. So in the United States and in Canada, Storm Fern drove up daily natural gas consumption to all-time highs. In the United States, we have seen daily demand hitting a staggering 4.6 billion cubic meters. But also in Europe, we have had Storm Goretti, which had a double impact on the energy system. It basically led to rather cold temperatures, which were combined with slow wind speeds. And this drove up daily natural gas consumption to well above 2,000 million cubic meters per day. That's about 75% higher than the daily average demand throughout the year. And we have also seen record daily demand peaks in Russia and China, in both cases driven by violent winter cold spells. So just to highlight once again, gas supply flexibility plays a key role in ensuring heat and electricity supply security, including in those markets in which we see a growing share of weather-dependent variable renewables. And now let's have a closer look to Europe, because Europe's LNG imports increased by 25% year on year to an all-time high over the October-February period. And here we are sort of showing some of the key contributing factors to this rather strong growth. We have seen higher demand in Europe, which was only partially driven by higher domestic consumption, but it has been complemented by rather strong piped gas exports towards Ukraine, which needed to increase its pipeline imports from the European Union after Russia's attacks on its natural gas production facilities. While natural gas demand has been increasing, we have seen that domestic production in Europe has continued to decline, mainly because of the lower output from the Netherlands and also in the United Kingdom. And these declines have been only partially offset by the production increases we have seen in Denmark or in Turkey. But I also would like to draw your attention on the lower piped gas imports from Russia, which declined quite substantially over the winter period by about 6 billion cubic meters. And this has been driven both by lower deliveries to the European Union after the halt of the transit via Ukraine, but also lower nominations from Turkey. And on the top of that, we have had lower storage draws, which further contributed to an increase in LNG imports into the European market. So maybe just one number to note here is that over the October-February period, LNG accounted for more than 40% of Europe's primary gas supply, cementing its place as a structural source of baseload supply for the European market. And now let's move to the implications of the Middle East conflict on global gas markets. So this slide gives us an overview of our forecast before the crisis. And we were presenting this slide back in January. On the supply side, the single most factor is, of course, the unfolding LNG wave. In the beginning of this year, we have been forecasting that global LNG supply will increase by 7% or 42 billion cubic meters. And I have to say the very good news is that out of this 42 billion cubic meters, 40 billion cubic meters are not from Qatar, but rather from the United States, from Canada, as well as some smaller projects in Africa. So this 40 billion cubic meters is still with us, and it will ramp up through the year. In terms of piped gas flows to Europe, our assumption for the year, and it still stays, that it will slightly decline, primarily because of lower Russian piped gas deliveries, but also Iran's pipe gas contract with Turkey ends in the middle of the year. And when it comes to piped gas supplies to China, we do expect them to remain broadly flat, although there is some downside risk considering the upstream difficulties in some of the Central Asian countries, primarily Uzbekistan. Now, the demand side is, of course, always a bit more complex, a bit more uncertain, but our view was that on the back of this improving supply fundamentals, global gas demand growth will accelerate from 1% in 2025 to around 2% in 2026. And this would be very much driven by the Asian markets, where we forecasted an increase of around 4%. And whenever I was presenting this slide, I was saying that this picture can be easily distorted by the forces of geopolitics, including Russia's ongoing invasion of Ukraine, various tension points in the Middle East, and of course, evolving trade policies. And this is unfortunately what is happening at the moment. Geopolitics are once again disrupting the well-functioning of natural gas markets. Now, this map shows us a selection of gas infrastructure which has been impacted by the Middle East conflict. Altogether, we estimate that the region's natural gas output has plummeted by more than 25% year on year since the beginning of March. First and foremost, the Strait of Hormuz has been effectively closed since the end of February, and this led to a steep decline in LNG production, both in Qatar and the United Arab Emirates, together accounting for almost 20% of global LNG supply. Second, two trains in Qatar have been severely damaged by missile attacks, and according to the assessment of Qatar Energy, it would take 3 to 5 years to repair them. But we also see that because of the export restrictions, oil fields have been shut in the region, which naturally leads to a reduction of associated natural gas production and is, of course, negatively impacting the supplies to the domestic markets, including in Saudi Arabia or in Iraq. And besides that, we have also seen attacks on more local gas production and processing facilities, which is, of course, further reducing gas supplies to the local markets and is negatively impacting gas-intensive industries such as fertilizers, and is also undermining electricity supply security, especially in the import-reliant markets such as Iraq. Now, this slide shows us the very critical role of the Strait of Hormuz from an LNG importer perspective. The dark blue bubbles indicate the Asian markets. The light blue bubbles shows the European import markets, and we clearly can see here that the direct exposure of Asian markets is significantly greater. Back in 2025, around 90% of the exit flows from the Strait of Hormuz were destined to Asia and accounted for over 25% of the region's LNG imports. In contrast, only about 10% of the exit flows went to Europe and met just around 3% of the region's natural gas demand. So it is quite clear that Asian markets are more directly exposed, but I also would like to remind all of us that we are living in an increasingly globalized gas market. And here we are just showing how the correlation between TTF and JKM prices have evolved over the last decade. The correlation between the two stood at the rather weak 15% back in 2015, and increased to over 95% in 2025, reflecting the more intertwined nature of Asia and Europe. And this also means that the supply and demand trends of one region can transpire to other markets and influence their price dynamics. But let's move back to the more short-term market conditions. On this chart, we are showing the year-on-year change in LNG loadings from the key export regions. And when we are looking at March and April, we see that global LNG supply declined by around 6% compared to the same period of 2025. And we also clearly see that this decline is driven by the Middle East, where loadings plummeted by around 18 billion cubic meters from Qatar and the United Arab Emirates. Now, these declines have been partially offset by the rather strong increase in LNG supply from North America and Africa. And of course, prices have reacted swiftly to this sharp supply disruption. On this chart, we are showing how TTF and JKM prices have been evolving since the end of February. In the first 2 trading days after the closure of the Strait of Hormuz, TTF prices jumped by 70%, while JKM prices more than doubled over the same period of time. And both of them reached their highest levels since the 2022-23 gas crisis. We also see that JKM prices have been more reactive to the supply disruption, and this is partly because Asia is more directly exposed to the heart of LNG flows via the Strait of Hormuz. Now, after this rather strong volatility in March, we can see that prices have somewhat moderated down throughout of April and have been in a wait-and-see mode since the announcement of the ceasefire agreement. But we are still well above the pre-crisis levels of natural gas prices, both in Asia and in Europe. I also would like to draw your attention on the gray area on this chart, which indicates the spread between TTF and JKM prices. Before the crisis, TTF was actually trading at a slight premium compared to JKM. Now this flipped, and since the start of the crisis, JKM prices have been trading at a premium of over $2 per MMBTU compared to TTF, which is of course needed to attract more flexible LNG cargoes towards the Asian market to at least partially offset the steep decline in LNG flows from Qatar and the Emirates. Now, one question is, of course, how the market is balancing out in this context. And on this slide, we are showing a selection of supply and demand factors which have been influencing price formation throughout March and April. The very first bar shows that the loadings from Qatar and the United Arab Emirates have, as we mentioned, plummeted by 18 billion cubic meters. Now, the good news is that almost 2/3 of that decline has been offset by a rather strong LNG supply growth coming from other regions. And this includes new LNG capacity, primarily ramping up in the United States and in Canada. But also, very importantly, we see improved feed gas supply at some of the legacy producers, including Angola, and Nigeria. And this also contributes somewhat to offsetting the decline we see from the Gulf. When we are looking at the piped imports to Europe and China, our estimate that they marginally declined compared to 2025. And then, very importantly, when we look at the demand side, in Europe, natural gas consumption have fallen by an estimated 2%, mainly on the back of stronger renewable power output, which in a way depressed gas-fired power generation. But very importantly, when we are looking at the last bar, the other markets, this essentially refers to all the efforts made by Asian markets to reduce natural gas use across the power and industrial sectors. And Frederick will discuss this in a great detail, all these components, but maybe just to note that we have seen in Japan, in Korea, in Thailand, regulatory incentives to increase the use of coal in the power sectors at the expense of LNG usage. And of course, China is playing a very important balancing role in this system, with the country's LNG imports plummeting by 25% compared to last year. And some of those declines are also underpinned by gas to coal switching dynamics. Now, I think that when we are looking at the short term and we are considering the summer season ahead of us, one key question will be how Europe's storage campaign will evolve in this context. If the European Union would aim to reach a 90% fill levels by the 1st of November, that would entail 10 billion cubic meters of more storage injections compared to 2025. If the aim is to reach 80% of fill levels, storage injection rates would need to remain close to their 2025 levels. Now, when we are looking back at the injection rates since the start of April, we see that they have been about 20% below their last year levels. And at the current injection rates, the EU is on track to reach just 70% of fill levels. So it seems that there is a need to accelerate storage injections. But of course, they are rather weak because we are in a relatively tight supply market. And of course, seasonal spreads have been negative since the start of April, averaging at -€1 per megawatt hours. So there is limited commercial incentive to put natural gas into storage. Now, beyond the short term, I think it is important to recognize that the current Middle East conflict is also altering the medium-term outlook. And this slide gives us a bit of a summary of the implications for LNG supply. On the very first bar, we are showing that since the start of the conflict, around 18 billion cubic meters of LNG has been lost due to the closure of the Strait of Hormuz. Now, assuming that it would take around 8 weeks to ramp back the Qatari LNG trains to their normal operating rates, this also would lead to a loss of around 10 billion cubic meters compared to a baseline scenario when they are operating at their nameplate capacity. But very importantly, when we are looking at the third bar, we see that the 2 damaged trains are also leading to substantial supply losses over the 2026-2030 period. assuming that it would take 4 years to repair them, the cumulative supply losses would amount to 70 billion cubic meters. And on the top of that, some of the expansion projects of Qatar might be also delayed, further reducing LNG supply availability over the medium term. So altogether, when we bundle these various bits and pieces, we see that the cumulative LNG supply losses total to around 120 billion cubic meters over the 2026-2030 period. But we also need to put these numbers into broader context. 120 billion cubic meters accounts to roughly 15% of the new cumulative LNG supply, which is expected to come to the market over the 2026-2030 period. And this essentially means that the new LNG supply, which is coming from primarily from the United States, will be largely offsetting the supply losses from Qatar. But we also need to know that most of the supply losses from Qatar would be concentrated in 2026 and 27, and this essentially means that the effect of the LNG wave, about which we have been speaking now for some time, will be delayed by at least 2 years. And this also means that the market will remain tighter longer than previously expected. And with that, I would like to give the floor to my colleague, Frederick Ritter, who will speak us through the implications on the Asian markets. Thank you.
Great. Thanks very much, Gergely, and good afternoon to everyone. So let's take a closer look at the LNG dynamics at play over these past few months and how these tie in with Asian demand side dynamics, because of course this is a central part of the story. It's something that Gergely has already touched on, but let's dive a little bit deeper into some of these individual cases. So we're all aware that the closure of the Strait of Hormuz implies this 20% cutback in the world's LNG supply, essentially being cut off from the global market, and this has of course led to a significant supply shock. We've seen a similar version of the chart on the left here, but while Gergely was looking at loadings, the chart on the left here is looking at delivered volume. So once a cargo has been loaded and once it has actually been delivered to an import market. Now, what we see is that global LNG trade grew by around 40 BCM, or about 7% in 2025. This was far higher than in any other year since 2019. And this chart shows that we've seen these 13 months of consecutive year-on-year demand growth. North American liquefaction projects accounted for the overwhelming share of incremental volumes during this period, carrying the market to really a new phase of growth that was bringing much needed support to the market. No, as is clear on the chart on the left, this has turned, of course, to a year-on-year decline in delivered volumes in both March and April this year. In March, what we see is that loaded cargoes were continuing to be delivered throughout the month, and this meant that we only had a decline of around 5.5 BCM in delivered supply from the Middle East and from Qatar and the UAE. In April, however, the full 10 BCM of supply cut was felt by the market, and we would expect that any subsequent full month of closure would lead to a similar drop in Middle East volumes, of course. Now, if we look at January to April this year, LNG supply remains up by around 6.5 BCM. This is LNG supply that has been delivered. And this is what's left, essentially, if we turn to the chart on the right, this is what's left after new projects driving around 15 BCM of growth year on year, legacy projects adding another 8 BCM. Key markets here are Nigeria, Russia, Norway, and Malaysia in pushing up this legacy share. And then the Strait of Hormuz closure has cut over 15 BCM of supply from the market. So we have around 6.5 BCM of extra supply available to the global market thus far this year. But we've added another element here at the far right of the chart. If we look at the LNG volumes that China, the single largest LNG importer globally today, has not taken in this year, so essentially its decline year on year in LNG imports from January to April, then we get closer to 10 BCM of incremental supply available to the rest of the market, excluding China. And this is central to how the market is balancing today. So in the next slides, let's have a closer look at these dynamics. So balancing the global LNG market on the demand side has centered on Europe and Asia these past years. Europe and Asia have not grown their imports simultaneously in any given year over the period that we're showing. Essentially, growth in one has invariably meant a decline in imports in the other. So this was most notable in 2022, 2023, in that crisis period, but it was key also in balancing the market in subsequent years as European market dynamics either eased or tightened. In 2025, for example, despite significant LNG supply growth, as we mentioned just before, a tight European balance drove record LNG imports from the region, which essentially pulled cargoes away from the Pacific Basin and Asia. And what we see is that in 2026, we would have expected these dynamics to shift. We would have expected both regions to take in more LNG as supply grew by around 50 BCM without the Strait of Hormuz closure. This is what we could have expected or would have expected for 2026. Instead, of course, the cross-basin trade-off is still very much in full force in early 2026, as we see limited incremental supply going into Europe, while Asian LNG imports have declined. Now, key here is the role of China in Asia. And what we see is that the percentages at the top of the chart show China's share in the year-on-year movement in Asian LNG imports. And we'll get a better look at this in the next slide visually. Now, here we're focusing just on Asia. We're splitting up the region into China, India, legacy importers, Japan and Korea, of course, and other Asian markets. Now, after a weak 2025, as we saw previously, Asian LNG imports were starting to recover coming into this past winter period. However, as the region is the most exposed to LNG supply from the Strait of Hormuz, and generally among the most price sensitive when we think about import markets globally, Asia saw its imports drop starting in March this year. Now, while some smaller markets have kept their imports up, for example, over these past couple of years, year on year, LNG imports have eased across the majority of Asian buyers, including Japan and Korea, which generally have a much stronger purchasing power and are much more covered with long-term contracts compared to spot-heavy markets elsewhere in the region. Now, I want to zoom in on two markets on the next slides to highlight how their markets are really balancing and how this is in turn balancing the global LNG market. These two markets are China and India. We'll focus first on China here. Now, on the left, we have quarterly demand growth by sector, which softened considerably through much of 2025 and continued to do so in Q1 2026. While there have still been organic factors or growth factors in the market for gas, demand actually fell year on year in March, following a clear slowdown already in February this year. Now, year to date, demand is estimated to be up by only around 2.5% in China. On the supply side, we see how domestic production has been broadly sufficient to cover incremental demand, while LNG imports have turned down. You'll notice that the chart on the left and the chart on the right, supply side and demand side, don't always match on a quarter by quarter basis here. And that is because I haven't included storage movements in these charts, which themselves have actually had an increasingly important role in balancing the Chinese market in recent years. What we see in Q1 2026, for example, is that greater storage withdrawals were key in balancing the Chinese market. So as the Chinese gas market has expanded over these past years, so too have its options in servicing this demand, as well as the volatility and seasonality that goes with this demand. And of course, as we saw in the earlier slides, this has knock-on effects on the global LNG markets, and of course has a role in balancing the dynamics that we can see in other regional markets. Now, on the other side, on the next slide, India is another market where we see demand recovery has been cut short by the current supply shock. India published quite good and specific data on demand, which gives us a great understanding of how markets are being affected by the jump in prices. There are a number of highly price-sensitive sectors at play here. We're talking about fertilizer production, refining, petchem as well. And these are sectors where there can be a degree of fuel switching, but that can also face a degree of outright shortages, depending on the sort of protection that governments will put in place and depending on the markets we're talking about. Now, faced with this reality, of course, governments are choosing to protect certain sectors. In India, for example, this has notably been the case for city gas distribution, residential demand, for example. But spreading this help to all sectors for an extended period of time is likely to prove costly for markets like India, for other markets in South and Southeast Asia as well. And so what we see is that as the crisis drags on, when we think about it, we're already halfway through the month of May. These impacts will increasingly be felt in markets that have for a long time been expected to drive the next wave of demand growth in the medium term. This is something that we are keeping our eyes on in understanding how this crisis will have not only short-term impact, but also medium-term impact, and how gas will develop its role in some of these markets. So I'll hand it over back to Gergely to wrap it up.
Thank you, Frederick. And dear colleagues, please allow me to conclude with a few key takeaways. The Middle East crisis is disrupting both regional and global gas markets, and is clearly impacting short-term dynamics while also altering the medium-term outlook. We estimate that the regional gas production dropped by 25% year-on-year since the start of the conflict due to a combination of production shut-ins amid the closure of the Strait of Hormuz, lower associated gas output, and attacks on natural gas infrastructure. The immediate impacts are felt across the regional gas markets, with lower supply leading to production curtailments in gas-intensive industries, rising electricity supply concerns, and is ultimately reducing the export revenues of many oil and gas-producing countries in the region. But the ripple effects on the global gas markets are also obvious. The sharp decline in LNG supply tightened market conditions, drove up gas prices, and is leading to gas to coal switching and production curtailments in gas and energy-intensive industries. The European storage filling season might be also become more expensive and more challenging than previously expected. And beyond the short-term implications, the conflict is also altering the medium-term outlook for natural gas. The Middle East crisis so far reduced cumulative LNG supply by around 120 billion cubic meters for the 2026-2030 period, largely because of the damage caused to Qatar's two LNG liquefaction trains. And this essentially will delay the effect of the LNG wave by at least 2 years. So markets will remain tighter for longer than we previously expected. And there is also a very clear call to strengthen the architecture of global gas supply security through continued adequate investments across the gas and LNG value chain, diversified long-term contract portfolios, and closer international cooperation between responsible producers and consumers. Dear colleagues, we would like to thank you for your kind attention and looking forward to to a continued discussion with all the stakeholders of the gas and the energy industry. Thank you.
Thank you very much, Gergely and Frederick, for these insights into your report. If you made one thing clear, I think it is that the global natural gas market will need time to recover from the current situation, and that we see a certain demand reduction in the Asian power and industry sector, especially in India. Und für Europa, liebe Zuschauerinnen und Zuschauer, sehen wir, dass Gas weiterhin eine tragende Rolle im Energiemix spielt und auch im Energiemix Deutschlands, insbesondere aufgrund seiner Flexibilität als Backup für erneuerbare Energien. Wir haben aber auch gesehen, dass die derzeitige Krise im Persischen Golf auf der Angebots- und Nachfrageseite ihre Spuren hinterlässt, je länger die gegenwärtige Situation anhält. Und wir sehen, dass die Befüllung der Gasspeicher für die kommende Heizperiode kein Selbstläufer wird. Ein ganz herzlicher Dank nochmal an unsere beiden Referenten, Gergely Mollner und Frederik Ritter von der Internationalen Energieagentur, für ihre Einblicke und ihre Einordnung. Danke auch an Sie, liebe Zuschauerinnen und Zuschauer, für Ihr Interesse an diesem Webinar. Die Präsentation stellen wir Ihnen wie gewohnt im Nachgang zur Verfügung und eine Aufzeichnung des Webinars finden Sie auch wie gewohnt zeitnah auf unserem YouTube-Kanal. Ich wünsche Ihnen noch eine erfolgreiche Restwoche und freue mich, wenn Sie auch bei unserem nächsten Webinar wieder mit dabei sind. Bis dahin, auf Wiedersehen.